Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Narratives are so important in the financial markets. The stories drive market positioning. Till about a month back, stories of US inflation peaking, a recession, and a Fed pivot were being used as we saw a broad based dollar sell off. This sort of changed after a few surprises on the data front, with the US posting very strong NFP and low unemployment rate, giving Fed the room to hike more and keep rates higher. Market positioning once again changed, and now there are some talks of inflation making a comeback and a terminal rate uh, much higher than 5%. JK, yesterday we had a few Fed members speak. How are you interpreting their message, and what are your thoughts on yesterday's rate hike by RBI?
Yes, good morning. Let's start with RBI. It was a hawkish hike by RBI, indicating more rate action may be warranted and continuing with the stance of withdrawal of accommodation. Yes, there was no indication of a pass. It means they are continuing to see uncertainties on price developments and perhaps do not want to reduce the relative attraction of rupee for foreigners, even as the currency trades with a fresh weakening bias. Also, perhaps the resilience of our economy, firming up of urban consumption demand, improving rural demand, could be giving them confidence that their continued fight against inflation would not be affecting growth. They are also conscious in projecting GDP growth at 6.4% for FY24, lower than the current fiscal. Full year inflation projection for this year is projected at 6.5, but slightly moderating to 5.3% next year. And they also, pointed to protracted geopolitical tensions and rising commodity prices as behind the inflation remaining somewhat elevated. The projected current account deficit is expected to moderate in the second half of this fiscal. With headline inflation under check, comfortable projection around current account and fiscal deficits, stronger FTA flows expected, bumper harvest, and comfortable forex reserves equivalent of 9.5 months of imports, as well as relatively stable rupee and a consistent monetary policy aimed at containing inflation. All this should see India as a macroeconomically stable economy. From this perspective, it is positive for equities and neutral for the rupee, as RBI keeps the door open for more hikes. Obviously, the external deficits are hindering any sustainable advance in the value of the rupee. Prudent central bank and government striking a balance between growth and fiscal prudence is definitely a big positive takeaway from the last two economic events in India, that is the budget and the monetary policy. For rupee, of course, it was neutral and it should respect the resistance around 83 subject to flows, and a retreat towards low 82 cannot be ruled out. Any attempt to break above 83 will definitely be met with central bank actions. So with not much focus on data, Fed speak drew all attention of players, though market moves were limited. And New York Fed President John Williams, who is one of the most dovish FOMC members, said to make sure real interest should stay at a sufficiently restrictive stance. And as inflation comes down, probably you can bring the rates down. But the important thing is we need a sufficiently restrictive. That's the key word here. And we need to retain a sufficiently restrictive stance in the policy. We are going to need to maintain that for a few years to make sure we get inflation down to 2%. So he's actually looking at maintaining higher for longer. Neil Kashkari said there is not yet much evidence that the rate hikes that they have done are having much effect on the labor market. And to bring the labor market into balance so that this, that tells more needs to be done. Overall, last week's jobs report has turned many doors back into cautious mode, and this is clearly making market rethink on its own expectations of the rates. Now, market expectation of terminal rate is almost matching that of the Fed's dot plot, latest dot plot, and I think coming inflation number on Tuesday will be determinant of how far further Fed may go. While most took Powell's statements on Tuesday as bordering on dovish, the subsequent speakers' comments have really been taken as hawkish. Equities found a roadblock after consistent hawkish statements. and a negative report about Google, as well as a call by President Biden for a 4% tax on corporate stock buybacks in his State of the Union address Tuesday night were hindering any progress in the stocks. Although this proposal, which could quadruple the current 1% buybacks tax, may be difficult to pass through as Republicans hold an edge in the House of Representatives. But it is a sentiment dampener. And in any case, stocks have tired a bit after a 7-week rise in Nasdaq, which has led this bull run in this cycle. We expect a consolidation in prices for a couple of sessions as we head into the all-important monthly CPI data on Tuesday. Meanwhile, in a sobering development, actually, Turkey Stock Exchange closed yesterday morning for the first time in 24 years to prevent a stock market rout, which followed that panic among foreign investors in the wake of massive death toll, which is now reported to be around 15,000, and at least 1 billion worth of damage to buildings from the strongest earthquake to hit the country in the last 100 years. So that's something that really sobering. Yields moved slightly lower in the US, but held near 1-month highs as investors adjusted for likelihood that Fed will hike rates further than previously expected following the blockbuster US jobs report. On the forex, dollar is holding on to the gains in spite of the jobs report, and euro is acting as the weakest among them all. There were several ECB members talking hawkishly yesterday. The Klaus Knott and then ECB's Nigel and even Schnabel, they were all looking for hikes of 0.5% in the coming month. And Knott was even saying there can be a hike in May also by 0.5%. But surprisingly, all these hawkish statements kind of fell on deaf ears as euro continues to trade in the weaker end of its recent range, in fact, trying to break 1.07 once again. But I think importantly, we have the flash German inflation numbers tonight, which is expected to come a bit higher. And then even the CPI number from US on Tuesday is expected to inch up a bit after falling continuously for the last 5 months. So it's back to inflation watch for the markets, and all the segments of the financial market should take cues from that in the coming days. Thank you.
Thank you, JK. And just to summarize, yesterday we had a hawkish hike by RBI. Strong rural and urban demand probably gave RBI the confidence to continue with its hike. Current account deficit is expected to moderate. Stability in rupee and comfortable forex reserve should keep the Indian economy stable. Fed speak drew attention yesterday. Dovish member, we had John Williams, who had the view that rates should be kept at a sufficiently restrictive level. Kashkari had a similar view. So basically, higher for longer is the theme from all the Fed members speak. So basically, the divergence we saw in market expectations of rates and Fed's expectations have narrowed. And for today, we have got German inflation to look forward to. That's it for today. Thank you so much for listening.